Hi guys, welcome to the introductory chapter of financial reporting. The plan, of course, is to record all the chapters, and because we will be carrying out, if you like, strong elements of blended learning where we will be doing questions in class and hopefully you looking through the theory on these videos. So really, what I'm hoping is that you watch this video and just sort of look at the theory, and then in class we literally just do the TYUs for these chapters. That's the ideal place that I'd like us to get to, so that we can make it as practical as possible. I mean, hopefully I will record some of the TYUs as well, but the whole aim is that you look at the theory and then we just come to being practical in class, and that gives us as much time. Okay, great stuff. I'll try and make them as short and as focused, and I guess they will be shorter because I guess I'm just literally going through the theory, so there wouldn't be that much interruption. Okay, right. So let's begin right at the beginning. So chapter 1, really we're just trying to look here or remind ourselves of what we already know. I mean, we're only bringing this to a level 5, a place of level 5, aren't we? Where you already know fundamentally what financial statements are. So ultimately, we're trying to prepare a set of entities' financial statements in accordance with prescribed structure and content. And of course, this friend of ours, a statement of changes in equity, we will look at again in case you have forgotten what that is. But primarily look at the main financial statements and just look at the structure. And what are those? Really, we have our statement of financial position, of course, our statement of profit or loss, and other comprehensive income. We will discuss that, what that means, literally as we go along. Or, I mean, sometimes it's referred to as you might have a statement of profit or loss plus a separate statement of other comprehensive income. It really doesn't matter. They're the same thing, whether you do it together or you prepare two separate statements. But the aim, if you like, is to enable better understanding of what's actually taking place, allow users to make better judgments, and of course, it is a faithful representation as well. And when I say faithful representation, it's sometimes good talking about these in context. Faithful representation being one of the two main fundamental conceptual parts of the framework. So faithful representation and relevance. So faithful representation is telling us what really happened. Other comprehensive income has a number of things that don't actually happen in the year. They're either things that are being recycled into this financial statements, things that are non-trading. So it would skew the user if you put them in the continuing events, so to speak, which is what the statement of profit or loss really is, the continuing events of profit happening during the year. So we look at statement of changes in equity, a statement of cash flows, nothing new as well. So cash flows typically just really wanting to understand that we had a cash position in the bank, if you like, in 2015, and then we have a cash position in 2016. So just the same way we have sort of retained earnings in 2015 and retained earnings in 2016, our profit statement of profit or loss, takes us from here to here. Same thing our cash flow is doing, taking us from here to here, which means, of course, with the cash flow, we typically see, if you can remember what these are, we will have cash movements due to operating activities, due to investing activities, and due to financing activities. So really, those are the three main ways, right, that cash would be coming and leaving, if you like, our financial statements. And it's easier now, it's good that, because of course it's very difficult to manipulate cash movements. They're just what they are. There's an objectivity with the statement of cash flows. It's just they're probably not very common, and not many. You need an educated user to understand a cash flow, a statement of cash flows, right? Not a cash flow statement like a cash flow budget. No, statement of cash flows. So as opposed to potential manipulation with your retained earnings from one year to the next, you have all sorts of policies and judgments and provisions and things like that that could skew. You could even just delay paying, if you like, and that can skew users, of course, in the short term, say for year to year. But overall, in the long term, there's very little you can do about it. Everything will even out over, like, for example, a 3 or 4 year period. We'll also be looking at accounting policies and explanatory notes, of course. I'll try and make these videos in short sort of bursts, maybe 10 minutes, and then we'll carry on that way. So of course, again, it's again for the user, for understandability and for faithful representation. It's important sometimes to highlight clearly events that are, when we say exceptional, due to the nature of those events that have happened. It's good to isolate them. So you can see here it says exceptional items. It's the name given to material items, if you like, of income and expenses, just so that we can explain. And of course, we will be disclosing, if you like, of these events. So typically, the accounting treatment here is to include the item in the standard statement of profit or loss, give it its own separate line, and disclose these in the notes. So if you like, some of these, typically you might have a gain or loss on the disposal of non-current assets. We might have discontinued operations. These are typically the ones where we might have, if you like, you're discontinuing an entire subsidiary, and you might discontinue it you might have traded only for 6 months with this subsidiary or whatever it is, or this operation. It's come to an end in those 6 months. You can see it'll be slightly flawed to keep it in the continuing operations for the 12 months. It'd be better to just, if you like, draw it out so that people can compare year on year, if you like, right? That sort of thing. So really, literally, things that are individual and that we want to almost highlight or separate out for our users, if you like to see. And we'll see what that looks like. Here's what a statement of financial position looks like. Nothing new. Here we are. We will come to see property, plant, equipment, investment, intangibles. This is your standard statement. Nothing really here. So of course, we will come to see, this is IFRS 5, assets held for sale. This probably will be new. So if the intention is to sell an asset that was currently under non-current assets, well, the plan is that we have an intention to sell it within the year. So because we have an intention to sell it within the year, it becomes a current asset. So we now hold it here. So what it means is that we're looking for buyers. There's activity regarding its sale. We are actively marketing it, and so we can recognize it. We'll come back to these core issues of with recognition is important. So we have recognition, measurement, reliability, measurement. But can we actually measure the thing? And that will help us with recognition. We'll look at all those sort of fundamental framework parts to financial reporting. Of course, we have share capital and retained earnings. None of that has changed. And of course, what will be new again for us is this question of other components of equity. So we will have movements, if you like, in fair value movements or evaluation movements happening during the year that kind of have to wait. I mean, of course, they're improving our equity section, but we can't recognize them in retained earnings just yet. We just have to hold them here in other components of equity. Might be to foreign exchange, due to restructuring, whatever it is. Key point here is that we hold them here. We'll see that as we go along. We will look at long-term borrowings. We will also look at what's referred to as deferred tax, and this is really for prudence, and we'll see that later on. The fact is that because we have these capital allowances during the year, due to, if you like, tax here in the UK, you are allowed certain capital allowances. You now notice that when you calculate your tax for the year on the profits that you have, that they're actually much smaller initially. But of course, the accruals concept says we must recognize, for accounting purposes, matching expenses to do with the revenue for that period, and the tax therefore required for that period, if you like, needs to be increased. If you've had a whopping capital allowance that's been allowed to go through your expenses, and therefore reduced your profit, and therefore your profit doesn't match per se the revenue involved in the income statement. So we also almost need to put through an additional tax expense. It's just for that time. But we'll see things will balance out as we go year on year. So we'll keep adjusting this liability as we go from year to year, because the situation starts to reverse itself. And then, of course, we have all these other liabilities, current liabilities, if you like, happening during the year. Sometimes you might not have all of them, but again, you might have a few of those. Okay, great. So again, like I said here, IAS 2, this is nothing new. A lot of this carries over from what you know already. IAS 1 requires that assets or liabilities classified as current if the intention is to settle it within 12 months and if it is part of the entity's normal operating cycle. So there is a current liability that arises, so typically on loans, for example, right? Typically you'll have a loan over a 5-year period, so we must clearly classify and separate out current liabilities for the 1 year and the rest post that period, if you like, and we must have this disclosed in the notes as well. Right, again, like I say, I think what's good is that I'll restrict these to 10 minutes so that you can watch them in bites.